In the world of business, there are two numbers that every entrepreneur, investor, and manager watches like a hawk. One tells you how well your product is selling. The other tells you if you'll actually stay in business. They are gross profit and net income. Many people use these terms interchangeably, but doing so is a dangerous financial mistake. Gross profit is about the efficiency of your production. Net income is about the health of your entire operation. Today, we're going to follow the journey of a single dollar from the moment it enters the cash register to the moment it hits the owner's pocket. Before we can have profit, we must have revenue. Also known as gross sales, this is the total amount of money brought in by the business. If you sell a pair of shoes for $100, your revenue is $100. But that $100 is raw. It hasn't been touched by reality yet. To calculate gross profit, we subtract the cost of goods sold, or COGS. These are the direct costs required to produce the thing you sold. If you are a shoemaker, COGS includes the leather, the rubber, the glue, and the wages of the person who physically assembled the shoe. Gross profit equals revenue minus cost of goods sold, or COGS. Gross profit tells you a specific story. Is your product viable? If your gross profit is too low, it means your production costs are too high or your price is too low. You are making sales, but the product itself isn't generating enough meat to cover the rest of your life. Now we have our $60 gross profit, but the business owner doesn't get to go home yet. Now come the operating expenses, often called the overhead or S&G&A, selling, general, and administrative expenses. These are the costs that don't change based on how many shoes you sell. You have to pay rent for the store whether you sell 1 shoe or 1,000. You have to pay the accountant, the marketing team, and the Wi-Fi bill. These expenses are the friction of running a business. Once we subtract the operating expenses from our gross profit, we arrive at operating income, or earnings before interest and taxes. This number shows how well the core business is running, independent of how it's financed or what the tax rate is. We're almost at the finish line. There are 2 more entities that want their cut: the bank, interest on loans, and the government, income taxes. These aren't part of your daily operations, but they are inevitable costs of doing business in the modern world. Finally, we reach net income. This is what's left after every single expense has been paid. Net income equals gross profit minus operating expenses plus interest plus taxes. This is keeping money. This is the number that can be paid out to shareholders as dividends or reinvested back into the business to buy new machines or hire more people. If this number is negative, you are in a net loss and you are effectively burning through your savings to stay open. Let's look at why you need to watch both Company A and Company B. Company A is a luxury software firm. They have a massive gross profit margin because it costs them almost nothing to copy their software for a new customer. However, they spend millions on fancy offices and celebrity marketing. Their net income is tiny. They are product-rich but operationally poor. But Company B is a grocery store. Their gross profit is very small, maybe only 10%, because food is expensive to buy. But they are incredibly efficient. They have almost no waste and very low overhead. Their net income might actually be higher than the software firms because they keep a bigger percentage of their middle money. To truly understand these numbers, we look at margins. Gross margin percent, gross divided by revenue, tells you how much markup you have. Net margin percent, net divided by revenue, tells you how much of every dollar of sales actually turns into profit. If your gross margin is high, but your net margin is low, you have an overhead problem. If your gross margin is shrinking, you have a production or competition problem. To summarize, gross profit is about your product. Sales minus direct costs. Net income is about your business, the final amount after everyone is paid. You can make sales all day long, but if you aren't keeping money, you're not running a business, you're running a charity for your suppliers and employees. Next time you look at a company's financial report, don't just look at the big number at the top. Scroll all the way down to the bottom, because the top line is vanity, but the bottom line is sanity.